Good morning, everybody. This is Jeanette Sims at TradeThirsty, little Leonard Skinner, Sweet Home, Alabama, to kick this party off this morning. I hail from Mobile, Alabama, so that's kind of our theme song. Seems like anywhere I go in the country, if that song gets played, everybody loves it. But anyway, just a little wake-up call for y'all. How y'all doing this morning? I'm from Alabama. Where are you from? We've got a great lineup for you today, and India. Good morning, New York. Good morning or good evening from Australia. All right, Sweden, Kansas, London, Vegas. I feel like we're in a rap song all of a sudden, right? Oregon, Florida, Canary Islands. Wow, y'all are from all over. Love it, love it, love it. It just goes to show that's what this game's all about. You can do it from anywhere, anytime, any place. And we're thankful to have you here with us this morning. I'm Jeanette Sims. I'm one of the founders of TradeThirsty. My business partner and I, really my dear friend Hubert Centers and I started this company. And we do this once a month. And typically on a Saturday morning, we come and we join you here and bring in a couple of traders, 3 or 4 usually, to share their ideas about the market. If you have any questions or comments or feedback, you can email us at help, H-E-L-P, at TradeThirsty.com, and they'll get that email to me. And I ask today that you be very respectful of our speakers because I will ban you if I don't like you. All right, so the first speaker today is Serge Berger. Then we have John Thomas, Sam Borghi, and Stephen Federell. These are 2 new speakers here for the first time today. Sam and Stephen are. So I'm excited to hear what they have to share with us today. I've been working with them on their concepts, and so I'm excited to see them present today for you. We're going to start with Serge, though. Serge is a great friend of mine, and we've broken bread several times. Very blessed to do business with him, and he always comes with a great idea. Today he's going to be talking about trading the gap. This is a new presentation he's put together for you, and so we're going to go ahead and turn it over to him. I am recording, so don't panic. If we lose the recording for some reason, that's just the way it is. That's the nature of the beast, but we're doing our best to bring it to you and take us a couple of days. Serge, I hear you miking up over there.
Yeah, how's it sounding?
It sounds pretty good.
Alrighty.
Let's make it louder.
No, I was going to say before, Jeanette, that is an awesome song, but as a Gator fan, those are fighting words.
Let me tell you what, I've got some, I was talking about, we call them Bammers, Bama fans I'm friends with, and pretty much all we talk about is Bama football 24/7 year round. And I had one of them Snapchat me a couple of days ago. He was coming in from Destin from work, and he passed a big, huge Hertz semi, and on the side of it, it said, Florida Gators, national champ, whatever, SEC champ, whatever. What's one year, one great year for y'all, whatever. And I was like, the few, the proud, the Florida Gators. So I know about you Gator boys, but yeah. If y'all had a song like Sweet Home Florida Gators and it was good and everybody loved it, I'd play it. But you don't, so.
All good.
Okay, all right, brother. It's all you. You have 1 hour.
So, I got an hour. Awesome. Yep. Thank you. All right. Well, good morning, folks, or wherever you are in the world. I know this is usually a fairly diverse audience. I'm going to talk about the gap this morning, and let me just quickly pop open the question box so I can kind of see if questions come in. There you go. Okay. All right. So let's talk about the gap. Jeanette was kind enough to introduce me, so I'm just going to skip over that part, although I think there might be a slide in here somewhere. But, the reality is that most of you guys, probably like the stock market, at least to some extent. You love the action, and you want to make some sort of steady cash flow from the market. Am I totally wrong with that, or no cash flow? That's kind of what people want to do. So the unfortunate reality is that most people kind of lack a strategy to do so, which is not to blame anyone. It is not easy. And quite frankly, most people kind of don't have the time for it in that sense. So, what I'm going to show you guys today is something that is really looking at the markets very differently from what a lot of other people out there preach and teach. And this is simply me being very very honest and truthful. I've done this now for 20 years, working on the buy and the sell side, places like JP Morgan and other places. So I know what works. I've seen what doesn't work. And so, my goal is to teach my followers and members to make money, because there's really, honestly, there's no reason for you to be losing money in the markets, particularly in the stock market. So that's what we're going to show you guys today, at least one strategy that I like to apply that you can use as some additional cash flow. My story about the gap is as follows. I was told early on in my career, literally, that the gap is crap, and excuse the language there, but that's actually the truth. And I was kind of dabbling in this stuff for a while, and then some of the guys I was working with, even my managing director at the time at JP Morgan, kind of told me that stuff doesn't work, and just to kind of stay away from it, and that making money from that kind of trade isn't really possible. So what I found over the years is I proved these people wrong, very wrong, and I strongly believe, and I know that the gap is real, it's tradable, and quite honestly, it's very, very profitable. So that's kind of my little story there about the gap, to give you a little bit of perspective. Making money in the markets really, starts by having a realistic, by being realistic, both in terms of your time availability and in terms of the potential returns. And we're going to address both of these very, very important points today in the presentation. In terms of the agenda, what are we going to talk about specifically? Well, we're going to start off very systematically. This is a very easy to follow presentation. And we're going to talk about what is a high probability trade, because I think a lot of people don't really know what that means. And so we'll talk about that. Then we'll continue on and talk about what the gaps are, the what and the why. We'll talk about the strategy itself, of course. That's what I'm going to show you guys specifically. And then we'll go through some examples, and of course we'll do some Q&A. So that's the agenda right now. So let's talk about high probability trades. The reality is that most of you probably lead fairly busy lives, and I really, really don't want you to spend 6 hours a day trading. Whether that's family, work or life, it keeps us very busy. So life doesn't happen in front of your computer. Even the best traders and investors that I know, even professionals, they don't spend the whole day looking at the screens. They're probably busy with meetings and doing other stuff, but they're not looking at the screen the whole day. So if you're doing that, I need you to stop doing that. So the approach that I preach and what I do and what works extremely well for myself, for my students, and the clubhouse members and everything else I've got, I want you to get your trades done and just move on. So if this is your view, and I mean, staring at these kind of three screens, something like that, this is a setup of mine that I had a few years back. And I wasn't looking at the screen so much every day, second by second, so to speak. But if this is your view for more than a couple hours a day from a trading perspective, most likely you're over trading and you're overthinking. Can I get a heck yeah if you can understand that? Just want to get some sort of engagement going here in the presentation. That's very important. So my entire approach is all about making sure we are involved in the markets, but passively so, and you guys will see what that means. Usually, unfortunately, it takes people at least 3, 4, 5 years to be able to appreciate that. So that's it. So yeah, even if you have one screen, by the way, and you're staring at that screen the whole day, that's no good. So here, let me show you one strategy that's going to basically help you stop doing that. So number one, though, we need to talk about, basically stop wasting your time. So stop wasting your time with low probability trades. What does that mean? Well, there's countless trading strategies out there. Obviously, I'm sure some or maybe all of you have tried plenty of things out there. And the reality is that many of them are very low probability. So the question is, why would you waste your time with anything less than true high probability trades, right? I want you to really think about that for a moment. Why we do anything less than really high probability trades, assuming high probability trades are frequent enough to find, which they are. So in terms of high probability strategies, the thing is, they exist in all time frames, and those time frames are long-term, intermediate term, and intraday. And by the way, this is one of my computer setups right now. I have multiple screens, as you can see. In fact, I have 6 of them, but a lot of that is just to monitor stuff and conduct my business, not me staring at it on an intraday basis. So, for example, from a long-term perspective, I think buying U.S. stocks, U.S. broader indices, after a dip of 20 to 30% on average, that is a great high probability long-term strategy. On an intermediate term basis, I have something called the B2 reversal indicator. Some of you may or may not be familiar with it. It's basically taking advantage of extremely high probability bullish and bearish reversals on an intermediate term basis and near term basis. And that's another type of setup that works very, very well. So those are high probability strategies. And before we talk about the strategy, I need to say one very clear word about day trading. You may have noticed already that I'm kind of not really in favor of day trading, and so I need to clarify what that means. I think over time, and I've done this now for 20 years, so I think I've got a good sample of what would work and what doesn't work, but I think day trading as a standalone strategy, let me be very clear, as a standalone strategy is a very low probability way of making money from the markets. In fact, I've yet to meet one person, and I mean one person, and I've worked with some very smart and good traders over the years, both on the sell side and the bell side and the buy side, and I've yet to meet one person that's actually consistently profitable over time using a complete sole day trading strategy. So in my opinion, the only way you can make money using at least a supplemental day trading strategy is by focusing on a specific trade setup that takes place at a specific period of time each day. So like I'm not a day trader, but I apply a specific intraday strategy in a very specific high probability way at a very specific spot in any given day. So like, for example, a lot of people are focused on currencies and commodities because those markets are open 24 hours a day. I just met with a commodity broker, actually currency broker in London just a couple of days ago, which is I did so much speaking that my throat is I still have a bit of a sore voice, and the reason is the fact is about 98% of futures and currency traders actually lose money, and the reason for it is because they think they can trade because the market's open 24 hours a day, as opposed to focusing on a specific part of the day when they know there is a good trade to make. Okay, and that's what we're going to show you guys today. So I think also day trading is best to be used as a supplemental or income strategy, so for additional cash flow and income, and that's exactly what I'm going to show you guys today. So the day trading strategy, or the gap trading strategy, I should say, that I'm going to show you guys today, I call it the one-day trading strategy for non-day traders, and of course day traders will like this too as well. It's called the open gap trade. How many of you guys on here are familiar with gaps? Do you know what it is? Have you ever heard of it, or is that a completely new foreign concept to you? Give me some yeses or nos. Okay, it sounds like it's a bit of a mix. Some people like it, some people know it, some people love it. Excellent. Okay, good. Some people have no idea. Fair enough. No problem. We'll address it all. So right off the bat, here's the statistics about the gap trading strategy I've now traded for 10 years. Basically, it's profitable between 85 and 90% of the time. So out of 10 trades, you get, between, let's call it 8 and 9 successful trades. The time requirement, the way I do it, is about 30 to 45 minutes per day, about 2 to 3 times per week. So you're not going to do this every single day because the opportunity doesn't provide every single day. And that's exactly why it works so well, because when it does provide itself, it tends to work. The key is to stay out of the trades that don't actually set up, as you guys will see here in just a minute. Okay, so we've talked about high probability trades, and let's talk about gaps and a bit of the what's and the whys in general. So first of all, what is a gap? I actually took this picture just a short while ago in London in the underground. I thought it was fitting for the presentation. Gaps exist due to imbalances between buying and selling pressure on average. And I will say, by the way, there are some conflicting opinions out there in terms of why gaps exist, but in my opinion, this is kind of a fact. So the gaps exist basically between buying and selling imbalances in the market. So the price tends to gap to an area of better equilibrium between supply and demand. And this is, of course, sort of almost the mechanics behind it. But as you guys will see, we'll explain this in much more usable terms. Another way of looking at it is that the gap basically represents an absence of buyers on down gaps or an absence of sellers on up gaps. So here's what a gap looks like as a first example. And you can see, for example, here we had a gap in this specific stock where the gap, the stock, gap lower, leaving sort of this vacuum here in this air pocket in the market. So it basically gapped to a better point of equilibrium. Same thing here. We had an up gap in this case. You can see broke nicely out of the consolidation area, and we ended up finding better equilibrium again up here. And if you guys can hold your questions until we get to the Q&A, I would greatly appreciate it, just so I can kind of flow through it easily so everyone can follow it. So gaps exist in all time frames and asset classes. And the key thing about gaps for me, aside from the day trading stuff, is that it actually gives you great perspective for trading and investing alike. So we'll talk about that more in just a second. Why do gaps exist? Well, they really exist due to news, and that could be economic data, it could be geopolitical news headlines. On the corporate front, it could be earnings, product announcements, improved, sort of outlooks, anything like that. It could be litigation. There's so much stuff that can move a stock. It could be even analyst upgrades and downgrades. I'm going to show you guys an example here shortly on that on a specific stock just recently. So really the reasons are kind of almost unlimited, but the point is that mostly it's due to news. In fact, it's almost 100% related to news. Well, gaps create opportunity and perspective for traders and investors alike. Like I said before, look at, for example, this specific gap here. You can see this stock gapped lower, and by so doing, it not only left this vacuum here in the chart, but it also broke and snapped this very important, very simple trend line. And you can see as a result of this down gap and the forceful down gap, what happened ultimately was a great indication of a move lower. In terms of the gaps, what's really important, what I think a lot of people don't do, is to understand that the reasons for the gap actually matters. In other words, not all gaps are created equal, and not all pieces of news that create a gap are equally important. So the news really does matter. For example, you have a U.S. job report. That tends to be a fairly important piece of news for the equity markets. In fact, for most markets out there, maybe less so the commodity markets, but for the most part, equities and even currencies, or at least dollar-related things. So the gap is important, whereas if you have an analyst up and downgrade, unless it comes from a really, really reputable analyst at a really timely point in time, or someone who highlights something that's totally brand new, no one's heard of, for the most part, those tend to not be huge movers of a stock beyond, say, the first hours or maybe a couple of days or so. So the reasons for the gap actually really do matter. Now, let me ask you this, guys. Has anyone ever heard in here this myth that all gaps tend to fill? If you can raise your hand if you have heard that before, it's important to know. Yes, okay, good. So it sounds like that sort of rumor has also trickled through you guys. Let me just quickly tell you, that is completely false, all right? The reality is that if you believe in this, it can lead to some really, really bad trading habits. I can unfortunately vie for this. I didn't used to believe in this necessarily, but I used to think they close more often than they do, and that in itself led to some really, really bad results. By my estimate of having tracked gaps now for, I think it's about 11, maybe 12 years at this point, about 7 or 8 out of 10 gaps tend to fill in general. Forget not in any given, not inside the day, not on any given day, just in general. If you don't believe me that not all gaps fill, go back and look at a simple chart of the S&P 500 and go back to, say, 2009. There are plenty of charts from back then that were gaps never filled, or you can look at other asset classes as well from back then. So again, just a simple example, so the reality is that not all gaps fill. They absolutely don't. It's about 7 or 8 out of 10 gaps ultimately filled, whether that's in a few weeks, months, or even in a couple of years or something like that. Okay, so this is an important concept to understand as we move into a little closer towards the strategy here. So there's different types of gaps. There are things called common gaps, which really are the ones that we want to focus on when it comes to creating this daily cash flow or weekly cash flow and sort of the income-oriented type of trading when it comes to gaps. And the common gaps really that take place within a range. In other words, and I'll show you guys a chart in just one second, where there's really no specific technical breakout or breakdown or anything like that takes place. It's just kind of a gap that where the market may have moved up or down a little bit. Maybe if it's U.S. equities, maybe they move because of, say the German stocks or UK stocks or something like that having moved up or down. Or maybe, for example, let's say on Monday morning, we might get a gap up or down based on the French elections in U.S. markets, right? Because clearly French stocks will start trading before U.S. stocks being 6 hours ahead. That could potentially create a gap. And depending on how volatile that gap is or how significant, if it remains within the range of the previous day, as you guys will see, it'll be a common gap. And that's the kind of gap we want to focus on for gap trading. Exhaustion gaps are the other type of gap we like to focus on when it comes to trading. Basically, here we're talking about moves to the upward or the downside that become very exhaustive. So let me show you guys two examples here. So this is a common gap example. And you can see, in this case, each day is sort of cut off with a vertical line. So this is day 1, day 2, day 3, day 4, and so on and so forth. And you can see that here in this specific day, the market gapped higher, but it never really broke above the previous day's highs or anything like that. So it just ultimately closed a little bit later on in the day. And even here, and this chart doesn't go far back enough, but if you would see the chart here, you would see that this up gap here also took place within a range here. So really, it was not a breakaway gap or anything like that, which is a very common gap. And again, those tend to fill most of the time. An exhaustion gap, which is the other type of gap we like to focus on from a gap trading perspective. And that's basically a gap like you can see here. We had a very steady move higher. In this case, this is the S&P 500 SPY ETF. And you can see ultimately it started gapping higher at the upper end of this trend, or at least ultimately became the upper end. And you can see it was a very exhaustive kind of move that quickly reversed lower, ended up filling that gap. And I'll show you guys this in more detail here in just a second. The other two types of gaps, and this is purely informational because I like to give you guys a little bit more color because I think you have to understand this kind of stuff. And again, guys, if you could please hold your questions until we get to the Q&A part, I would greatly appreciate it. The other two kind of gaps are the breakaway gaps and the continuation gaps. Both of these gaps essentially will make a significant change on the chart based on the break up or down. So for example, this here is a breakaway gap. This was actually Facebook in 2013, and you can see Facebook had kind of just been chopping back and forth and trading here initially, and then ultimately had a very significant breakout past resistance, and that is definitely not the kind of gap that you want to be fading. This is the kind of gap you would want to be playing with, and I'll show you guys that as well. Ultimately, you can also have something like a continuation gap. Here, this is simply just a continuation of the existing trend where you have an up gap, which just represents basically a continuation of the existing trend that the market has been in. So why do gaps close then? And this is another kind of thing where, the research and the trader talk out there kind of is all over the place. But quite frankly, in my opinion, what I've seen on the institutional trading desks that I've worked on, it really has to do with institutional investors not being willing to, say, bid a stock meaningfully higher overnight in the absence of any meaningful news or unless something has changed. So the same thing goes for the downside. So, for example, here you could see that the market gapped lower. That's this blue spot is the down gap on this specific day. So you can see the market opened here and had closed up here the previous day. And the reason why my traders will try to push the market back up here is because they want to get fair prices to maybe in this case sell the market again. In other words, get it back to the previous day's close in the absence of any news. And of course, then there are the people out there, such as myself and others, who actually try to make money from these gaps, understanding this very concept. So we will try to fade or sell into up gaps or fade and buy into down gaps, such as the one here, and we'll look at the example here in just a second. So why would you want to trade the gap? Well, obviously we focused on a lot of this concept of creating weekly or maybe monthly or even quarterly cash flow using a gaps trading strategy, which is really kind of my number one reason for doing it. It kind of just gives you a little bit more jingle in your pockets on a weekly, monthly, quarterly kind of basis, so that just kind of helps to ease the mind a little bit. It's always nice to make a little bit more money here and then. By the way, there are some great payoffs to be had as well beyond the little bit of jingle in your pocket. I'll show you guys in just a minute. From a risk management perspective, and let me quickly go back to this. I don't mean you can only make a little money. You can make a lot of money with this, but in terms of this sort of looking at it, I look at this as like an additional income source and kind of an additional sort of cash flow, if you will, because it's not a long-term profit. It's not a long-term capital gain, so to speak, right? These are fairly quick trades. Also, and this is probably almost more important for those of you that are also focusing on sort of intermediate to longer-term types of market trends, gaps are important to understand and study and follow for risk management purposes, to understand the significance of any given market's move, and really to gain perspective and get a feel for the market. And this is going to make sense to you guys the more you follow markets, when gaps specifically in the markets over time. So we need to start talking about qualifying a gap trade that's worthy of being faded. Well, market gaps in general, like I said before, in any time frame, not just intraday, tend to fill about 70 to 80% of the time. But by my estimate, about 80 to 85% of these qualified daily gaps tend to fill. I'll talk about what a qualified gap is in just a minute, but essentially it has to do with a gap that doesn't change, break out or break lower. It's really a common gap, like the kind of gap that's kind of small enough, juicy enough to trade, yet not meaningful enough to have sort of blown the chart aside away in one direction or another. If you go for a half gap strategy, which is really what I do, where we try to go for a fill of half the gap size, that tends to be, by my estimate, about a 90% probability of making money in this strategy. And that's really what I'm going to show you guys here. So this allows for some very nice base hits and cash flow profits. And by the way, every once in a while, you're going to get some serious home runs as well. I'm going to show you guys a stock that I hit a home run in this week using the gap trading strategy, literally just on Thursday, an actual example. All right. So what are the requirements? Well, number one, in order to be qualified for a gap fade strategy, the gap must be a common gap. In other words, it must be a gap, like I said before, that doesn't really break the chart in one direction or another. It just kind of happens to be a bit of an up and down gap after the previous night's close. And we don't really want any specific technical breakouts to have happened, or breakdowns for that matter to have happened as a result of those gaps. Okay, so that's a really important requirement. In terms of the weekdays, this might be a good little tidbit for you guys to know. I think that for the most part, honestly, the odds are fairly equal throughout the week, but I do tend to focus more on Tuesday, Wednesday, and Thursday for the actual gap fading strategy. Mondays and Fridays are a little bit worse for a gap fading trade, and the reason for that is as follows. On Mondays, you tend to have the markets being affected by news or maybe even mergers that are announced over the weekend or Monday morning. And then on Fridays, it's really kind of a wild card. Fridays, you have options expiration and people are looking forward to the weekend. Sometimes it's a long weekend where people are kind of antsy, or news over the weekend. Like, for example, we have the French election taking place tomorrow, so that's going to create some potential gap risk on Monday, and so on and so forth. So that's kind of the statistics that I look at from a probability perspective. In terms of the agenda now, we are really going to start moving into the strategy. We've talked about high probability trades. We've talked about gaps and the what's and whys. Let's talk about the strategy. So this is really the meat, guys. So the goal, again, is to kind of create a weekly, monthly, quarterly cash flow machine with this type of strategy. And it's got to be simple, it's got to be straightforward, and it's got to be repeatable. And those are the three requirements for me for any trading strategy. And this one really, really ticks all of these boxes. The odds work out very, very favorably over time, and really there's no stress. The trade either works or it doesn't work on any given day. Let's talk about it. So on any given day, three things can happen. Assuming there's a gap, either the gap closes in full, right? the gap closes partially, usually a third or a half is the most common, or the market continues to run in the direction of the gap and never even attempts to do any sort of gap fill close. So here's the thing. Here's the daily open gap definition. The gap essentially is the difference between the prior day's closing price and the following day's opening price. And if we look at this from an execution perspective, the strategy is to either sell or go short on up gaps or buy and go long on the down gaps. Like, for example, you have right here, you have a down gap, right? So you would buy it here, and I'm going to show you guys this strategy here in the next couple of slides. Jeanette, I think you just put the microphone on. Or someone did. Someone just got unmuted, I guess. So the general rules to follow is as follows. So number one, I like to use candlestick charts. That's really, really important. I want to use candlestick charts, and I'll show you guys here in 1 second just why. Also, you want to use 5-minute charts, which is more conservative. You can use a 1-minute chart. It's a little bit more aggressive. And if the gap is large enough, I also tend to use 15-minute charts for confirmation. So let me show you guys what that looks like. So here we have an up gap, and very specifically what we'll tend to do is we will look to see if we can fade this gap basically upon the first bearish reversal if it's an up gap, or upon the first bullish reversal if it's a down gap. And then you want to wait for follow-through selling. So here's what it looks like. In this case, we had an up gap. You can see that. And then we quickly got to exhaustion buying. You can see these long sort of tails up here. And then finally, we had follow-through selling either here or here, depending on how aggressive you are. You could have taken that trade and then shorted this this instrument. In this case, I think this was an ETF, the XLF ETF. Okay, and you can see how nicely that went very close the half gap, right about the middle between previous night's flow and the new day's open, right? Ultimately, but later on in the morning, actually later on the day, the entire gap, you can see it ended up going. So to me, the first target is always going to be the half gap. You can also use the overnight lows or highs as ready, because that's my trading strategy. But if you were waiting for the full gap, you may have wanted to take some off once this bar here occurred, this green bar, which was what I refer as the first bullish reversal, right? Alternatively, if you want to be more aggressive with these stop losses, it's not what I do, but one can do this as well. And I know people who do this, and they do it very profitably. They will wait. For them, it's a binary event. Either the gap closes in full or it doesn't. And they'll also use, in that case, they'll use the stop loss up here at the highs of the day, or of the after the gap. Or if it's a down gap, it'll be below here. I'll show you guys in just a minute. So very simple stop losses. And again, like I said before, the trade either works or it doesn't work. It's very, very simple on any given day. If you take a qualified gap and you go for the half cap, the chances are about 90%. If you go for the full gap, it can take a little bit more time throughout the morning. This black line here simply just divides the day. This is day one, whatever that day was, and this black line is just overnight. So this is when the trading day began the next day. Okay, so that's representing the gap. So let's talk about it step by step and go through a few more examples to show you guys, before I show you guys some real examples that just happened this week. So number one, you want to locate the first bearish or bullish reversal and follow through selling after an up or a down gap. If the market gaps up, you want to plan to sell or get short. If the market gaps down, you are planning to buy or go long. And then thirdly, if you want to, you can also wait for the break of the first 10-minute range. I'll show you guys that again here in just a second. All right, so let's go through a few examples. Here's an example of actually one of those 10-minute range examples. And you can see here, I'm just going to put the steps here so you can see them on the right, on the left, excuse me. We had, we had an up gap take place. Let me quickly put this microphone business here away. Okay, so we had an up gap take place here, and we didn't really have any strong exhaustion buying signals. There was no really big exhaustion candles take place in any sort of way. So I, in this case, waited until the 10-minute range to break, this was the low of the 10-minute range. So this is the first 5-minute bar, and that's the second 5-minute bar. And then here it broke, and you can see very quickly the half gap filled, which is around here. And then in this case, you have a bit of a bounce, and then the gap filled and closed very, very quickly. All right, let's look at another example. And this is an example that didn't work, but it also never fired off a signal, right? So here, neither did we have any strong buyer exhaustion, nor did we break below the 10-minute range. And you can see we never broke below, the entire day, in fact, we never broke below that 10-minute range, certainly not on a 5-minute closing basis, enough to take a trade to the short side. So that's how you stay out of losing trades, right? That's really, really important to understand. So unless there's an actual reversal below, you don't get out. You don't even enter the trade. How about this one? And this is sort of where you start to get into some really juicy bonus type of trades. You can see we have an up gap here, very clear exhaustion buying, a very big engulfing bearish candle, and follow through selling the next candle. Now, the gap had already closed, but given the severity of this bearish reversal, you can actually do a trade here, and irrespective of the fact that the gap had already closed, you can trade it lower. So these are the kind of trades that are real bonus windfall trades, and you get, I would say I get about maybe 3-4 a month of these, where you can really, really bank some nice money, and you leave them on for half an hour or so, just let them run, and just make some really nice money. So it's the bearish reversal here that's really, really important, irrespective of the up gap, although the up gap really was an exhaustion up gap, like we said before. Okay, so again, step 1, 2, 3, very, very simple and straightforward. How about a down gap example? Same thing as I said before. In this case, we had only a small down gap, but look what happened here. This down gap actually filled very, very quickly, right? But then about 15, 20 minutes or so into the trading day, we had a very strong seller exhaustion and follow-through buying. So one would have bought here, right, waiting for the gap to fill, which ended up actually filling over the next, let's call it, I don't know, whatever that was, 30 minutes or so. So again, seller exhaustion, follow-through buying, going for the gap fill, which again worked very, very, very well here in this example as well. All right. How about this one? Another quick example here. Another yet one more example. An up gap. You can see seller exhaustion. Buyer exhaustion. A big engulfing candle. Follow through selling, and boom, we entered a half gap very quickly. That's target number 1. Then we had a tiny, tiny, tiny bounce here for about 10 minutes. Not even 10. I guess maybe about 10 minutes. And then we continued to fill the rest of the gap. So, in terms of the instruments, what are the kind of instruments that you want to focus on? I think the primary focus really for anyone that's focusing on U.S. equities here is sort of your S&P 500, maybe your Russell 2000. You can use the SPY ETFs. You can use futures like E-mini futures. You can use the Russell 2000 IWM. You can use levered ETFs like the SPXL, SPXD, SDS, those kind of ETFs as well. You can use this. You can also use it on European stocks, by the way. You can use it on Asian stocks as well. It really works all over the place. And then lastly, what I like to focus on as well is looking at the sectors of the group ETFs, so to speak. So you XLF, the financials, the XLED energies, the industrials, the transports, all those kind of things. Those I think are really, really important. So let's look at some real-time examples of gaps that just happened actually over the past few days, so you guys can see that I'm not just making this up, that this actually really, really does work. So here, for example, this is just a few days ago. We had a very nice gap. I'm just quickly bringing it up here. Just give me 1 second. Here. So this is a real nice chart of the S&P 500. Again, you could use the Russell 2000. You could use whatever else you can see here. We had a down gap and then a very quick a bullish reversal take place. Yeah, we will look at AXB. That's actually the trade that I did this week. Good catch there, Terry. We had a seller exhaustion, followed through buying, and very quickly that gap filled. And you can see you could have left this on for a while as well because he was such a strong bullish reversal. How about here? Look at this one. Down gap, quick exhaustion selling, followed through buying, and boom, that gap closed very, very quickly, right? So that's another one. How about we can look at sectors ETFs as well? This is just a few days ago. I'll show you guys this one here, 1 second. So even on Friday in the financials, for example, we had that take place in the XLF ETF, right? Look at this, down gap, right? Seller exhaustion, follow through buying, and boom, we had a bit of a rally higher. These are 5-minute charts. If the gap is large enough, we'll do 15-minute charts. I'll show you guys some of those examples as well. Okay, so you can see that this really happens all over. So let's do this. Let me go through a couple of things I want to go through, and then I'm going to show you guys really, really good examples in AXP, American Express, and a bunch of other examples, trades that we just did this week, so you guys can see this. I'm not making this up. In terms of bonus tips, I think it's important to be watching large stocks like the Apples of the world and the banking stocks. If you're looking at a specific ETF, for example, or a specific group of stocks, you want to watch the largest stocks in that group. Like, for example, again, Apple would be your technology watch the stock. In the energy space, maybe you want to watch something like ExxonMobil, and so on and so forth. And banking stocks in general in the financial sector is really, really, really important. You could also use something like my proprietary beat reversal indicator for getting these qualified bullish and bearish reversals a little bit more in detail. So on any given day, the trade either works or it doesn't work. Right? We talked about that before. So the odds are in favor over your time. Very, very strongly, the odds are in your favor. In fact, empirically, however, I'll tell you that if the trade doesn't work out on the first try of the day, it's usually better to just kind of stay away from it. A lot of that is psychological because you'll end up doing revenge trading, so I prefer you stay away from it after you try it once, okay? So you want to avoid trading gaps on earnings reports, at least, fading gaps, okay? Fading gaps, you want to avoid that after earnings reports for the most part. You got to let the market settle a little bit. And like I said before, I don't think you need to revenge trade. This trade, you'll get so many opportunities over the course of 1 month to create some cash flow that you really don't have to try the revenge trade on any given day, okay? So what I want to offer to you guys here today is my gap trading course. It is a 14-part video series, and you're going to learn all the intricacies of trading these gaps in great, great detail. It's really a strategy for predicting and profiting from the move. So you're going to get a 14-part video series, which is brand spanking new. I just created this, and it includes a gap indicator and a scanner so you can find these gaps, and I'll show you guys this in just a second. You can learn all the intricacies of high probability gap trading strategies, how to use the gap trading strategy in all different time frames, long-term, swing trade, and all that kind of stuff. Also, you learn gap trading secrets, which is to say that it actually matters where and why the gaps occur. And we'll have 25 available to go at this price. And let me see here. Yeah, so the link to get it is thesteadytrader.com/order, www.thesteadytrader.com/order. And also, so you guys know, there is also in this the bonus midday trade, which is the other high probability trade for non-day traders. There's actually a trade that sets up around the midday each day, or at least 3 times a day. That is really, really, really high probability. That's also included in this course. You can learn about the breakaway gaps, which is the potential for huge winners. I'm going to show you guys an example in American Express, a trade that I did this week on using this strategy. That's really where you bank some really, really big money over time. We'll also learn about island reversals, and really it's all about being able to understand gaps through the lens of multiple time frames and technical analysis as well. So all this stuff is included and much, 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 much more. Now, here's the thing. We're actually going to have a bonus session that's going to take place for trading the gap in the next few weeks again. We just did the April one, so for anyone that will buy this today, we do about one bonus session for owners of this course and the indicator and the scanner once a month over the next few months. So you'll get a bonus session. So what I'd like you to do, for those of you guys that are purchasing this now, go in, watch these videos over the next few days or so, next week or two, start practicing looking at the market. Then you come back when we have the bonus session, and you guys will be sent an email, right, to be alerted when that session is, and it also be recorded, of course. So you can come and ask all your questions. You can also set up a phone call with me. So anyone that is looking to buy this today, I offer you guys a personal phone call with me. Okay, a personal phone call with me to talk about this, to walk you through any questions you have. So not only do you get the 14-part video course and the scanner and indicator, but you also get multiple bonus sessions actually for the next few months, including a phone call with me personally. All you have to do is set it up. All right, so let's talk about the gap indicator and the scanner, which is included in this course. All right, so what it does is it highlights gaps that are likely to close that day, as well as gaps that are not likely to close that day. It works for Thinkorswim, TradeStation, and NinjaTrader, and we're working some other platforms as well to be making it available on those as well. And the way that the indicator works and the scanner works is as follows. So for example here, let me show you guys a couple examples, and I'll show you guys real-time examples. So this is, for example, the S&P 500 on a daily chart. These are daily bars. So what it does is at the beginning of the day, like right when the market opens, like within the first seconds, okay, the market, the indicator will give you an up arrow or a down arrow depending on what kind of gap it is, and it'll tell you whether it's going to close or not. So for example, on this day here, just to focus on the most recent one, we had an up gap and a down arrow that appeared at the beginning of the day, indicating that the gap would close. And as you can see by the long tail, that gap did close. Here's the intraday chart. This is the same chart, just a 5-minute chart. You can see the market gapped higher, and the gap ended up closing by, I don't know, I guess this was like probably about noontime, a little bit after fully, and the halfway gap closed a little bit earlier. Okay, so that's how that works. It works for breakaway gaps as well. In this case, look at this. We had a down gap and an up arrow, meaning that the gap would close, right? So this is Netflix, and you can see that gap closed very quickly. Here, too, we had a down gap and an green up arrow, meaning that the gap would close, and it did. And also for breakaway gaps, guys. So all you guys were asking about breakaway gaps before, it works for breakaway gaps as well. Look at this. Big breakaway gap in the case of Netflix here, whenever that was, and it gave us a green arrow, meaning that the gap would not close, that you can trade with the gap. So it's really, really awesome. I'm very, very proud of it. So again, my strategy is to go for the half gap. In this case, you can see Amazon up gap with a down arrow, and it closed at well beyond the half gap. It didn't close the full gap, but it closed certainly the half gap. Same thing here, up gap, down arrow, meaning the gap would close at least in part, and as you can see, it closed well more than 50%. So very, very, very good stuff. Here's what the scanner looks like, and I'm going to show you guys the real scanner here in just a second, like the real life, like the real-time scanner, if you will. Of course, today the markets are closed. So you can see that what the scanner does, there's 4 different scanners, and it's divided up into up gaps, not closing, up gaps closing, and then down gaps not closing, and down gaps closing. So let me show you guys what that looks like. Let me just quickly bring this over along with a chart. Let me just quickly get this over here. Here we are. All right. So here, for example, is the chart of Humana, okay? And I'm going to show you guys the scanner. This is the scanner from yesterday, obviously, because today the market is closed, right? So this is a down gap closing. So in the morning, this populates right away, and it gave me Humana, among others, right? And look what happened for Humana. It had a down gap, right? It had a down gap, and it quickly reversed down. I'll show you guys the 5-minute chart. So it gave us a green arrow at the beginning of the indicating that gap would likely close. So let me show you the chart of Humana so you guys can see this. This is the chart of Humana on Friday, okay? Big down gap, right? Exhaustion selling. And we didn't really get any follow-through buying until a little bit later on in the day, but you can see the gap ultimately closed very, very strongly for the rest of the day. Okay, so you guys can see how nicely that works. So let's talk about breakaway gaps here in just a second. And again, the scanner and the indicator works for Thinkorswim, for TradeStation, and NinjaTrader. So that's the offer, guys. A 14-part video series, including the gap scanner indicator that will allow you to make monthly and quarterly cash flow. It's just $197. You can go to the studytrade.com/trader. And let me show you guys one trade I did this week in American Express. Okay, and unfortunately the scanner I can't go back to what it showed us on Thursday because it's irrelevant, right? But look at this. This is the gap in American Express from, darn, let me bring it up, sorry. From last Friday. Sorry, it's last week, right? So here, let me zoom in. Let me show you guys this. And yes, you guys, by the way, you can also trade options on this. Like if you want to just buy options or sell options, if the gap is big enough, you can certainly do that. So this is the gap from last Thursday, American Express. You guys might have recalled. And look what happened. We had an up arrow that the indicator gave us, or the scanner and the indicator, meaning that the gap would not close. All right. So you can see that you would have never even attempted to try to fade the stock, right? In fact, what it told you is that it's a breakaway gap. And here's what we did. Let me show you guys the chart of of American Express. Here. Let's go into AXP. All right. This is the gap. The breakaway gap from last Thursday. So what I did is once the stock started breaking back above its 10-minute range, I actually bought the stock for a runner for the rest of the day. I mean, this was an awesome trade. So this stock gapped higher about 2.6%. And once the stock goes a little bit higher up here, so just on that gap alone, we made, just on that day trade alone, we made, and I closed it just a little bit before the close at the day, we made another let's call it 2.1% or so just doing that trade. So whoever was asking for, do you guys see that? I think it was Terry, right? You asking about that? So it works with these as well. So the scanner will show you all these trades every single day, pop up very, very easily, simple up and down arrows, and so you can follow that along, right? Oh yeah, sure. So sometimes the indicator won't work, right? If it most of the time when it doesn't work, it's because because the trade never triggered, right? So like for example, let's just go back to the example of the S&P 500. Let me quickly show you. Like we looked at this trade earlier, right? This up gap here that I showed you, right? So a lot of times, if the indicator doesn't work, well, the indicator will work most of the time, okay? Yes, Barry, you can call me if you can send me an email. Jeanette, can you type in the email address there for Barry? And it works. Yeah, this works with futures. We do it in the E-mini futures as well. So this works just as well with E-mini futures as it does with equities and with ETFs and with commodities and whatever. So that's how that works. Yeah. Okay. So you can see here, for example, again, we had a seller exhaustion, followed through buying, and the gap closed very quickly, right? But again, unless you have that, you don't enter the trade. So sometimes you'll get a signal, right? But you still have to wait for the gap to actually, the entire, all those examples I walked through before to actually trigger you a valid trade, right? That is basically how that works. Yeah, so this will work on any price stock, Joanne. It doesn't matter if it's a $20 stock or a $500 stock. It really doesn't matter. So, yeah. Yeah, it works in crude. It works on gold. It's going to work as long as the examples I walked you through with the bullish and the bearish reversals actually actually, trigger the signal. That's the more important. It'll work with currencies as well. Although with currencies, they're open 24 hours a day, so you're gonna have to see when that open gap takes place. But if you trade currencies, by the way, there's a midday trade that's in the course that I explained that works very, very well with currencies. Okay. Yes, Osman, you're good. Osman, you're all good. I believe Jeanette is going to send out the recording of this. Yeah. So the main aim is to find the reversal, but again, it has to be taken with context. You really have to have an indicator and a scanner, and that's what we do. That's what we have, the indicator and a scanner, which gives you these opportunities every single day. I just showed you guys the example here in American Express. This was a breakaway gap, right? But then which worked very well on Thursday. But then, like for example, Humana, which was a trade on Friday. It popped up on the scanner like I showed you guys before, right? And look at how beautiful that gap closed on Friday. I mean, if you caught that one, that's one heck of a trade. That's an entire percent in a stock, which that may not seem a lot, but for a quick gap trade, that's awesome. And yeah, it'll work fine on for Nadex type of trades as well. So I believe my time is pretty much over here, guys, but I very much appreciate everyone's attention. If you guys want to create additional cash flow and income on a sort of monthly and quarterly basis, I think this would serve you very well. And thanks, Jeanette. It was a great pleasure being here.